As more of you have been completing our How Much Do I Need to Retire quiz, I've noticed something surprising. Many of you are hoping to retire early. Average age that I've heard from you is 58. But here's the catch. If you want to retire at age 58, there's going to be a significant income gap before CPP and OAS kick in, typically around age 65. And if you're not prepared, this income gap can throw all of your retirement plan kind of off course. The stakes are really high. Typically, this is the time when your net worth is the highest, and no one wants to risk running out of money or having to depend on family later on in life. So in this video, I'll show you how to avoid that. We'll walk through a case study here today to highlight the triple whammy that early retirees specifically face. I'll give you kind of the standard or the typical way that this problem is typically dealt with by most people and why there's actually maybe a better way to answer this question. And then we'll look at the 5 or maybe 6 key strategies that you might be able to use as you think about how you might want to bridge the income gap in your early retirement. So this is a very common question, right? You're somewhere in your 50s, you know you can't make it to 65, and you're pretty sure that you've got enough to consider the idea of retiring early. Maybe you're even quite confident, but how much earlier can you retire? That is the big question. And what are the trade-offs? Is it really possible? All very real questions. And for whatever reason, maybe the investment person in your life seems maybe better equipped, kind of maybe running the investment portfolio than thinking about any strategic decumulation plan. Often you might get really simple, vanilla, maybe off-the-cuff answers to these very valid questions. So let's get some real answers here though, through a case study. Let me introduce you to Marty and Jen McFly. They've been married for 35 years. They've got adult kids that are finishing up university. They themselves are in their 50s. And here's what their balance sheet looks like. They're doing pretty well. They've got a home worth about $1.4 million over in Alberta. Their RSPs, they've saved their whole life. They total about $1.6 million. They've got $300K in their TFSAs between the two of them. And then on top of that, they've got $500,000 in non-registered assets. That's a mix of kind of bank cash, some investments, which came in from a recent inheritance that Jen actually received when her mom more recently passed away. Frankly, it kind of got them thinking about all of this early retirement stuff. So we got about $2.4 million when you kind of add up all the liquid stuff, the investment accounts to fund this. Marty's got a good $250,000 a year job working in the lab in the engineering field, and they've been saving about $30,000 a year for the last few years. In retirement, they figured that they wanted to have about $10K per month of net after-tax spending dollars coming in, kind of like retirement paychecks that we like to call them. Before we move on, by the way, if we haven't ever met, my name is Steve Willems. I'm a practicing certified financial planner and wealth advisor with the Willems Wealth Planning Group out here in BC. We started this channel to help you plan for your own retirement, helping you think about how to plan and arrange your investments, your income streams, and ideally pay less tax along the way. Now we'll get back to that case study in just a sec, but the reason early retirement in Canada is such a big issue is because early retirees face a triple whammy of issues, all with their own implications. They're rather obvious, but when stacked together, they're pretty formidable. First, you're likely going to have to be drawing down your assets sooner. So you're reducing your capital or your principal. You're just making the pile smaller. Second, then of course, by doing that, you're reducing the asset base size available for compounding in the future, right? During these years, since these balances are typically at their peak, missing out on an extra 1 or 2, maybe 3 years of extra compounding can result in very real dollars being impacted later on down the line. So not only are we making the pile smaller, we're reducing its ability to produce fruit for us in the future. And then third, finally, when we're leaving the workforce early, you're also not going to be saving like you were when you were working. And so those final few contributions into, say, your RSP or your pension or your savings pots, wherever it's been going, those are also going to be missed. So you stack all of that together and it has a massive effect. Let me just show you. So with a kind of pile of assumptions and best guesses, if Marty pulls the plug at age 58, as he hopes, here is what their net worth projection looks like. So just shy of about $6 million at the age of 85. and then stepping down modestly to about $5.5 million at the age of 95. So overall, the plan works. They can spend at that level as they had hoped. They're not running out of money. There's no forced downsizes here. These numbers work. Now let's see what happens when we push back that retirement age by just 3 years to see the cumulative effect on that single decision. Well, at age 85, we're now seeing a net worth of about $7 million. And at age 95, it steps down to about $6.8 million. So this single decision to push back retirement by 3 years looks like it'll turn out to be kind of all else equal. Again, not changing spending or anything like that. It's about a $1 million decision at their age 95. And Marty kind of knew that this was a big deal, but he probably didn't think that this was a $1 million decision. So that's the triple whammy on the balance sheet. But why is early retirement tricky also from an income angle or a cash flow angle? Well, because of this. We've talked about the retirement spending smile in past videos, that average spending is the highest at midlife, kind of around this time in your life. Now, this data is from JP Morgan down in the US, and it's based on folks with $1 to $3 million of investable wealth. So exactly the McFly situation that we're looking at here. So perhaps not the average early retiree, but those who are doing a little bit better than average. We see it peaking and then gradually decreasing by about 33% till their early 80s. So this is pretty tricky, right? Like we've got these 3 triple whammy balance sheet issues, and at the same time, we're also wanting to spend the most, at least according to this data, right? We're able-bodied, we're thinking clearly, we're healthy. Now is the time for that spending. Again, all of this is completely valid. So what can you do to bridge that early retirement income gap? Well, first, let me share with you kind of what the standard answer is to this question, the easy answer, maybe the vanilla answer. So the standard approach would be kind of a simple rule of thumb, kind of used as a means of assessing how much you can spend in your early retirement. So the first would be maybe the 4% rule, which says that you can withdraw 4% of your retirement portfolio kind of each year and not run out of money. So in Marty and Jen's case, we said that they have about $2.4 million liquid. So 4% of $2.4 million is about $96,000. Now let's keep in mind that they need about $10K per month of net retirement income. So at a glance, we already kind of see maybe a $24,000 gap here. And the more time we actually think about the 4% rule, the more gaps we'll actually see, right? Is 4% a good number to use if CPP and OAS will supply a greater percentage of their retirement income later on, right? What about inflation? What about if the markets go to the gutter, right away, right after they retire? What about taxes? Can I make up for it by spending less later on, right? Admittedly, this rule of thumb fails to account for most of those variables. So that's the standard approach, right? Not great, perhaps helpful to know if you're kind of playing in the right part of the field, but not tactically helpful. So the better approach is actually kind of a strategic early retirement withdrawal plan, or just simply kind of a retirement income plan. Now, ultimately for Marty and Jen, this will be the final result after having walked through a kind of multifaceted approach to kind of figure out how they actually plan to spend those go-go years, right? How do they want to kind of intersect with their kids' lives financially? How do they want to support those causes that are important to them? Kind of what a good retirement looks like, what a bad retirement looks like. And having done all of that, kind of they'll have a handful of strategies that they can then contemplate to kind of bridge this early retirement income gap. So let's review what those options would be now, and maybe start with the tempting but potentially suboptimal options, right? Now keep up. We're going to be going through a lot of stuff here pretty quick. Now, of course, we know that an early draw of CPP is going to reduce that amount down by 36% on top of the inflation adjustment that we otherwise would have taken. And this is going to be locking in that amount for the rest of their lives, right? It's a massive decision, really. So for these guys, when we isolate for just that single variable and we run it through the model, here's what we see. At their age 85, their projected net worth would be about $5.821 million versus $6 million in that base case. So this is a difference of about $175,000 at their age 85. But if they make it to age 95, their net worth is actually going to be dropping to $4.9 $915 million. And so a difference of a massive $597,000 versus that base case. Again, no change to any of their spending here, but the big difference is just that in taking CPP out at 65 and you're living longer, you're going to be getting an extra $622,000 of lifetime government benefits out of those programs. Again, here when we look at the net worth chart, it still works. The numbers still work. We're just talking about optimizations at this point. Now, the second option would be to activate an early reduced defined benefit pension. Often these old defined benefit pensions have what's called an earliest unreduced option, and it often hits sometime in the late 50s. And while that might be an option for some, maybe for you, unfortunately, it wasn't an option for Marty and Jen. Neither of them had ever participated in a defined benefit pension plan, which is why they saved as aggressively as they had. Now, the third option would be to complete some type of home equity unlock. They could maybe downsize and move to create some extra cash to convert that equity to retirement income, or they could even think about maybe a reverse mortgage. I've talked about some of those ideas in this video up here. But again, for Marty and Jen, neither of those seemed reasonable. They loved their home, they weren't ready to downsize, and the thought of adding debt at this point to fund spending seemed backwards and counterproductive, and I completely agree with them. Now, the fourth option would be some type of tax-free or tax-advantaged withdrawal. So pulling money from TFSAs in that non-registered account. They've got about $800K of some prime after-tax money here that they could use in early retirement to help fund that gap. And if they pick this path, they would want to start with the non-registered pile and hopefully kind of put off never actually touching the tax-free savings accounts. But if, say, their balance sheet was maybe smaller and the TFSAs could bridge that gap, that could totally work here too. This is actually what we modeled earlier in their base case. And you can kind of see, again, like it works. It's not terrible. Now, the fifth option would be a more thoughtful RSP meltdown strategy and just initiating it a few years earlier. The problem with option 4 is that they're going to have a few years here of very low taxable income, which means low tax rates that aren't getting used up. And the RSP meltdown strategy is going to instead initiate RSP withdrawals to create a base amount of income, and then cash flow will get topped up to them from their non-registered account. Now keep in mind, we're keeping their total actual lifestyle spending, we're keeping that the same in all of these cases. Where the differences really show up is both in their lifetime tax bill and their estate tax bill, as we see here. At age 85, this strategy would have saved them about $122,000 of personal tax. But here's the real kicker. Their estate tax bill would be $991,000 lower, almost $1 million. The net of these changes also leaves an extra $789,000 of extra after-tax estate value for their beneficiaries at the age of 85. If you run this exact same scenario all the way out to their age 95, the personal tax savings jumps way higher to $532,000 of lifetime personal taxes saved, and in an estate that's better by about $643,000 at the end of the day. Now, if you haven't done this kind of analysis on your situation and you're kind of starting to see that maybe there's some depth here that maybe you haven't quite covered off yet, we do this kind of work all day. Every week we set aside a few hours to kind of help give back to folks in the YouTube community here, and we answer questions. So if you'd like to take advantage of that, you can complete that How Much Do I Need to Retire quiz to get started, or you can just book a call with myself or someone from the team, and we'll help you get answers to those questions. So 2 options, I'll put both of those links in the description below. So as you can probably see, most people probably don't achieve the confidence that they'd hope for simply by kind of running back of the napkin calculations. The stakes are really high, and unfortunately, our financial lives are complex systems of various interdependencies, right? One thing has a ripple effect over to another, and while this is certainly true during the accumulation phase, it's especially true during the decumulation phase, where your income plan will affect your investment plan, will affect your tax plan, right? Piles of cause and effect relationships. But hey, we love this stuff. Really can't think of more fun problems to solve for folks than this, especially when it's an area that can feel overwhelming for many people. One of our greatest joys is helping folks get clear and confident on this area of their life. Anyway, that's all for now. I hope you found this helpful as you plan for your own retirement. Thanks as always for watching. We'll see you in the next video.